Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. All right, guys, welcome to our Tuesday Night Podcast. We are live, and tonight you get Melissa and myself.
Together, side by side.
Yeah, that's right. There we are.
Yeah.
We are the guests of the show tonight, guys, so hopefully you don't mind that. We've got a lot of stuff to talk about, and apparently, looking at the chats already, I have a lot of rants to get out.
You do. Charlton's waiting. He said, how many tonight?
It won't be hard.
No, it's not going to be hard.
It's not going to be hard. Yeah,
No.
There's some craziness going on. But
Yep.
I guess we'll start off with deals are falling apart. I mean, I'm not proud of that, but I think buyers are waking up. We just had a deal fall apart today. And agent called me up and said, Todd, I don't know what to do here. We're kind of at the final hour. We're supposed to close. And the two big issues that we had that we couldn't overcome is that there were the insurance, property insurance was way more than what the borrower had expected or the lender had expected. And it came in, like really high on the property insurance. And then the amount of property tax that they were collecting or escrowing from the buyer took the buyer where they needed a lot more cash to close, and they didn't have it. So the deal is falling apart. We tried to work both sides, tried to get the seller to come down. And this is one of the things that I want to really kind of talk about. If you're thinking about selling your house right now, or if it's on the market, if you're the day before settlement and you need to come down another 3 or 4% in order to make a deal happen, and you say no, it's probably a huge mistake.
Yep.
Especially when we're going to talk with what we're going to talk about tonight and the way the market is behaving. And with interest rates, I mean, mortgage rates are going sky high. There's all kinds of stuff. We're going to dive right in. But guys, we appreciate you spending your Tuesday night with us. And as always, make sure I don't knock something over here. As always, guys, we love it when you share our content. I'm so grateful for everyone. Thank you so much for our viewership has gone up significantly in the last year. We're so blessed. I just want to get that out of the way and say how thankful that I am personally with your viewership and your comments and the questions and a lot of shares. I mean, obviously, a lot of what we talk about here to many people doesn't make sense in our industry because they're like, Todd, why are you you make money when you sell property? And why are you talking about the things that you're talking about? Is because, we really do care about what's going on in the market. And we feel that there are a lot of buyers that have really been shafted. And, we're not happy with what happened either. The whole, runaway freight train that we've experienced over the last couple of years. But I thank you so much for sharing our podcast. We've, checking the analytics, we do get a lot of shares, and that really is helping people. It really is helping people. And the amount of calls that are coming in, the amount of emails that we get on a daily basis, comments, we know that people out there, we are helping, and I think we're calming down a lot of the buyers too that have felt like they haven't been able to compete with their friends and their peers as they've gotten themselves into debt that they're regretting. I talked to somebody today that said, man, I've gotten a raise at my job. My husband makes good money. We bought a house in 2022 and we don't know where all the money's going. We did a budget and I looked and our fuel is through the roof. Our grocery costs are through the roof. Everything has gone up, guys. And the biggest thing for the buyers that are, really remorseful is that their insurance rates have gone up. And I've said it on the show before. I mean, we're seeing 20, 30% insurance hikes. We're now seeing to where, buyers are looking at properties and insurance companies when they're trying to get quotes are now saying, well, there was a claim back on that property for $20,000 back in 2021 or back in 2019. And now we're seeing where, the new buyers are being penalized from the old buyers' insurance claims. So, but anyway, we'll dive in. And Melissa?
Hello, everyone. But I just wanted to follow up with what Todd just said, because you guys are calling into the office and basically saying they need to hear what really you're putting out there, Todd, because you are the sound of reason for many of the viewers. And that's why I think you guys are sharing it around, because it's so important that the word gets spoken like this, because not only is it refreshing for you, but you're actually getting real talk backed up with stats. So I just wanted to mention that as well. But yes, please, we're so grateful. And please comment your questions in tonight. I'm going to be here to just filter them over to Todd, and we're going to give opinions. We're also going to go through some specific market regions that we've chosen to kind of give an overview of what's happening in the market on those specific locations. So lots to talk about. Happy to be here. Happy to have another Tuesday night with all of you.
Yeah, and guys, remember, we are live, so go ahead and chat your comments and your questions in. We will try and answer as many as we can. I don't know why I can't open this link here. All right, let's see. All right, never mind. We won't worry about it. But anyway, guys, I want to jump right in because I want to talk about this Yahoo Finance article, because a lot of people, I'm so tired of hearing lenders. And if you're a lender, I'm sorry. I just, the shenanigans that from some that I'm hearing, and agents too, about how, rates are going to come back down. Just go ahead and get an ARM. You can refinance later. Don't worry about it. They're not going to stay at this level. I want to just let everybody know, the average mortgage interest rate over the last 50 years has been about 7.7%. Okay. So when we're talking about a 30-year fixed mortgage, so we're not looking at mortgage rates that are outrageous right now, despite what people think. And what we're going to talk about tonight is, what would you prefer have happen? Do you want home prices to drop, or do you want interest rates to drop? We're going to address some of those, what can happen. We had a poll. It got cut short somehow. We don't know how it happened, but it was reflective that most people thought that, so there were options. What do you think will happen if interest rates go back to 4%? And the choices were housing prices will continue to skyrocket, or that they'll flatten out, or that the home prices will drop. And, no one picked home prices will drop. They either said, home prices will skyrocket again, or home prices will flatten out.
And
right?
the majority stated cause a spike in the home prices.
Right.
Yeah.
The majority did. So,
Yeah.
But unfortunately, it got ended short. We didn't get that many votes. But then we asked, hey, what do you think would be the effect of why your decision? If you thought home prices were going to go up, why do you think that was? And some people said, well, because there's a lack of inventory still, and so forth. So we'll dive into a little bit of this, but I do want to pull up this Yahoo article here because it's talking about a housing economist and that is warning of 8% mortgage rates. And guys, we are at 8% right now. We'll take a look at that. But economist warns of 8% mortgage rates. This is as of September 21st, so just a couple days ago. But anyway, mortgage rate changes will have a big impact on the short run, while job gains will have steady positive impact over the long run. Yoon said. This is Dr. Lawrence Yoon. He's the chief economist of the National Association of Realtors. And again, if you've watched my videos, you know that I interviewed him. You can find that video on our channel. I actually challenged him in the video. I haven't asked him if he'd podcast again with me.
Well, I was just going to say, maybe it's time he could come
Yeah,
back.
I don't know. He would probably say no now, right? But who knows? We won't put words in his mouth. We'll reach out and ask him.
Yeah.
But Yoon said in a statement before adding in the press call later that in the short run, it's possible that mortgage rates may go to 8%. And, whenever you start hearing them talking about things like that, these economists, I feel like a lot of them are out of touch. And I'm not saying that that's Yoon, but I am saying that a lot of the economists are out of touch. A lot of them are bureaucrats. A lot of them are working in companies where they have certain agendas that they have to, they're pushing, right?
Yes.
And so I'm not saying that's with Dr. Lawrence Yoon, but I'm just saying that I take what they say with a grain of salt. Really, he did like the fact that I was a contractor and swung a hammer.
He did.
He kind of got a kick out of that. But anyway, as I was challenging him, right, he said, "Oh, but I do like the fact that you swung a hammer." Existing home sales fall again in August. This is no news, guys. Right, we're looking at existing home sales are tanking big time. We're going to show you some markets across the country where you're seeing price declines like we expected and have been talking about. It's accelerating. Existing home sales in August reflect mortgage rates that were locked in during the months of June and July. And that's what a lot of people don't realize is they're like, yeah, but we saw a spike. We saw a spike in second quarter of house sales and, mortgage applications were up. Well, no duh. They were up because people get locked in, 30, 60 days ahead of the settlement, right? We're always looking at backward-looking data.
Mm-hmm.
But anyway,
and that narrative is pushed. I mean, that's what's pushed, and that's what people go off of. So it's not accurate when they're making decisions. So and news being reported.
100%. Yeah. So anyway, since then, mortgage rates have climbed above 7%, and since the Fed's September projections keep another rate hike on the table, mortgage rates are not likely to drift lower in the absence of new data warranting a reconsideration of the outlook. I mean, the problem is that inflation's gotten worse.
It has gotten worse.
It's gone up the other way.
Yes, it
so
has.
Instead of it coming down to the 2%, projected 2%, and by the way, I never bought into the narrative that, we're looking at the CPI or the core inflation being, at 3.1 or whatever, even when they said it was 9.1. I mean, we all know as consumers, however they get that data, we know that the prices of everything have just skyrocketed.
Yep.
And now fuel, right? Oil is going through the roof.
Yep.
Over $90 a barrel. Gas here is like $3.89.
Yeah, it's very.
For
I
regular.
know. I was just thinking. I put some gas in today, and I noticed that it had gone up.
Yeah, so it's gone up.
Yeah.
But anyway, when we look at that, but it says that, basically you look at this mortgage chart here in this same article, and we could see the major dip down. And this is where I believe, I was listening to somebody who thought that, he was a podcaster that thought that maybe, there was some crazy stuff happening by the Fed. They were actually challenging it from a legality aspect of it. Didn't follow what happened to it, but I think they said they were suing the Fed because they believe that there was something not right with them dropping the rate to zero. I don't know anything about that. I'm not an attorney, but it doesn't make sense to me that we would drop interest rates to zero and get everybody into debt. I mean, it makes sense for the banks when they know they're going to get bailed out.
Yeah, I mean, it seems there's a hidden agenda there, but of course, we don't know that for certain.
Yeah, the article goes on to say, while elevated rates make it more costly for buyers, it's also convincing many homeowners to stay put rather than to sell. And we kind of covered this in a video, but I'll just, for those that didn't hear it, I think it was on last Thursday evening. But anyway, according to Redfin, 91.8% of the U.S. homeowners with a mortgage have an interest rate below 6%. But more alarming, guys, is 82% of mortgages actually have a rate under 5. 62% have a rate below 4. And, and it gets crazy. A quarter of the mortgages are, I think below 3, 2.7, 2.75. So, I think the biggest thing, and we'll take a couple questions, but I think the biggest thing here is that what I'm going to show you guys and what I'm going to be talking about over the next couple of days, hint, hint, on Saturday morning, more specifically at, I don't know, I think, what do we publish at 9:30 or 10:30, Joe? 10:30 Saturday morning. You're not going to want to miss that release because it's going to shock everybody. But anyway, what I want to talk about here for a minute is that institutional buyers are ramping up, guys. While we're sitting here on a Tuesday night and we're talking about, the people that really want to desperately buy a home, get into a home, they've been waiting on the sidelines. They've been kicked to the curb time and time and time again. They've been outbid. They didn't have enough cash. Thank God you didn't. because we now know that would have been nuts. We know buyers that did that and couldn't afford it. If you could afford it, then that's fine. Spend your money, get what you want. But we know that there were a lot of people that bought and fell into the exuberance that was happening in the market that shouldn't have. And we're seeing the effects of that now with the people that can't afford to make their mortgage. Millennials are defaulting on their credit cards now. They're defaulting on their car loans. Defaults are going up in mortgages. And now as a result of 40% of the mortgages out there, I think were created in the last 3 years, something ridiculous. Now it's time to pay the piper. But anyway, any questions or comments before we
let's get
start looking at data?
So, Charlton here, banks will tighten loans. Banks will tighten loans and require larger down payments. So affect only large McMansions would be built. Good for commercial apartment landlords. Anyways, I feel a new Todd rant tonight.
I'm glad you have such faith in me, Carlton.
We know they're
that
coming.
You can come to the
we know that
come to the table to listen to the rants.
But he does have a question here. Todd and Melissa, great shows. What do you think will be the major type of home loans? ARMs, 15-year, 20-year, or 30-year, or something else?
Yeah.
Possible return to assumption loans?
Yeah, I think what we're going to show you tonight, there's already companies out there that are they've got a website on how to get assumable mortgages, and you can go in and look. It's like a multiple listing like nothing ever before. It's actually based on, the states that you can buy a home and assume they're 3% mortgage. We'll take a look at that. But I think the bulk of what we're seeing right now is, which is, and we're also going to show you that data, is the new home construction market where, in new homes, for the first time ever, it's weird. It's not an anomaly. I don't know what it is, but it's mostly first-time buyers buying new homes, and that's never happened before. And what they're doing is they're enticing these buyers with low, cheap mortgage rates, conventional, fixed rate mortgages. They're buying them down, so they're spending a lot of money doing that. Rate buy downs are very expensive. I mean, you get a half a point, and I'm not a lender, but it's thousands of dollars for half a point. Mm-hmm. And if you want to go even higher than that, it's just a ridiculous amount of money that you have to bring to the table to buy down. But I think we are starting to see ARMs being pushed, which is scary in itself because a lot of people they're taking the loan because they can get down. Maybe they can get down to 5% or something in an ARM. But the problem is if interest rates stay at 7.5%, 8%, which I think they will for years, I don't think this is going to be something that's going to be corrected anytime soon. But I think what will happen is if they lock in, then, in 2 years, the rate goes to something else. And then in 5 years, it goes, and so on and so on. So if they're staying at that home, which if you're buying now, you better be planning on staying there for 5 or 7 or 10 years, or you'll be underwater when you sell. You'll owe more money. You'll have spent more money than what your home will be worth probably. So I think it's not a very good option to do an ARM, and a lot of people are being convinced to do so.
Mm-hmm. So. I know we're going to look shortly at basically what it would be for a home price with the current mortgage rates, but there are people out there that are spending $1,000 on a car payment. I mean, it's an incredibly expensive time. And I was even thinking about the deal that you mentioned at the beginning of the show about, the sellers weren't willing to really put in any more money. And unfortunately,
sellers didn't put any money in that deal. But anyway,
but the buyers, I think sometimes those buyers are like, this is a blessing in disguise. Like, thank God we didn't get into this situation. I don't know those buyers, but I'm just saying in the current scope of what's happening currently, I can see many of them being like, this was probably a good thing.
Yeah, well, especially if they have to walk away from the EMD. Well, I'm going to tell you guys something. Well, that's a good point, because a lot of what, and guys, I'm not telling you to default on your contracts, all right? You see all the lawyers out there, with, licking their chops. Like, oh, good, we get to. I've already been challenged. I already get lawyer. I mean, it's not every day, but I mean,
Right.
certainly, we've gotten those emails where people are like, you shouldn't have said whatever. The bottom line is this, at least in Maryland, my experience, a lot of these contracts, man, they don't seem to be very enforceable.
Right. We've talked about
And
that.
I'm just saying, it doesn't seem to me, I'm not a lawyer, but I see where the buyers blow the deal up. It was the sellers blowing the deal up, by the way, because they were getting, they're like, wait a minute, I could get another $50,000, lose this buyer, right? But now we're looking at where the buyers are blowing a deal up and they just don't even care. They're just like, screw it. I signed a contract. I had one of those myself.
I know you did.
And I was like, what?
Yeah.
All right. Well,
Yeah.
here we go. Let's roll, man.
Yeah.
Come on. Right. But the thing was, but here's the thing. If you're a buyer and an agent is telling you, hey, you want to get your deal accepted, you got to put down a big heavy duty EMD run in the other direction, in my opinion, right? Because you should be able, here, I recommend like 1%. So if you're buying a $500,000 house, $500,000, a fine earnest money deposit, $5,000.
Right.
Right. Where I see people have gotten screwed, buyers have gotten screwed. See, in Maryland, and I don't know about other states, I know a lot of states are like this, but I don't know about your state. But in Maryland, it takes two people. It only takes one to cancel a contract. You can do a unilateral, buyer can send a unilateral contract termination, right? Fancy word, meaning that I don't need the seller to sign it, right? See, I do know some of the legal terms, even though I'm not a lawyer. But anyway, unilateral contract termination. If it falls within your contingencies, and financing contingency is a contingency. If you have a financing contingency and you can't get a loan, if that contract says that it's predicated, you buying that house is predicated on you getting a loan, and you can't get a loan, that's a contingency. As a buyer, you have a right to get out of the contract here in Maryland, right? Now, here's the deal. If your agent was like, "Ooh, we're buying a $500,000 house, put down $25,000 because you're going to put it down anyway. So give me an EMD of $25,000." Well, guess what? You're screwed if the deal falls sideways and the seller doesn't want to sign, because you need a bilateral release of earnest money deposit. So what that means is whoever the escrow agent is holding the money. And I stopped being an escrow agent.
I know.
Right, we can tell them why. But anyway, I stopped being, we used to hold escrow. I don't want any parts of it because people are looking at me like, I want my money. And I'm like,
Right.
well, I can't give it back to you. The law says I need this form signed where both parties agree to release the money. Sometimes my own client was mad at me, right? And I can't help it as an escrow agent. So we just said, you know what? We're going to make this easy. Don't give me the escrow checks. Give it to the title company. Mm-hmm. Give it to somebody else. Let them deal with the money. But what happens is you need two signatures, at least in Maryland, to get your money back. You need the seller who's pissed off that you just blew the deal. And they're like, I'm not signing it. Some of them are like, I'm not signing it. Well, it's kind of dumb, but a lot of them get an attitude about it. And if I'm representing the seller, I'm like, just give them the money back. Right. Let's freaking move on. We'll find another buyer. But some sellers just get it in their... they just want to.
They want to fight.
They want to fight.
Yeah.
Right? They want that $2,500, the $5,000 check. Just give it back.
I know.
Right. But what happens, guys, is don't just keep in mind when you're buying. Be mindful. 1%, at least here, if we're representing you. And by the way, if you need good representation and you're not in Maryland, send us an email. Reach out to me. I can get you pointed to an agent if you need one. All across the country, guys. You've got an amazing broker network. Just send us an email. Tell us what you're looking for, what state you're in, what city you're in. Joe, you might want to flip up my email address there. There we go. Oh, he's already got it up. I'm not. That's because I couldn't log on.
It's all right. I got it.
You
Here
got
it is.
Thanks, Joe.
Yeah. Thank
All
you,
right.
Joe.
So, any more comments?
Well, we do have a super cash. Let me just.
I wish I could see it.
Oh gosh.
I don't know why I can't.
We need to get you
there.
squared away there. Can you not hop in?
No.
Oh, Joe, can you help
Go
me
ahead.
for a quick
Go
moment?
ahead. Go
Okay.
ahead.
So we go to Super Cash.
Here,
Good
Joe,
evening,
here's
all.
mine.
I believe if interest rates went to the highs of the 80s or 90s, our economy would sink like a millstone. I don't not trust the data, and experts failed us all pre-2008. Any thoughts?
Man, I tell you, we echo the 70s so much in the data. The only thing that we're missing right now, and it's because of stimulus. And by the way, you know, what's this ramp up stuff now for student loans? You have up to 12 months now, even though you have to, Biden just signed this into, do you know that?
Well, I got an alert of something today.
Thanks, Joe.
Go ahead. Go into that a little bit.
So apparently Biden put something into play that if you have student debt and you're supposed to start making your payments October 1.
Correct, I know that.
If you can't afford that or it's not worked into your budget, there's a 12-month ramp up.
Oh, what does that consist
And they
of?
can't report anything to your credit bureau, right? They can't say you're late. Pay what you want. Pay what you want. Pay as you can up to another year. I mean, look, hey, you need some votes.
Gosh. Well,
The only thing we're missing, you know, and I've got data here, dates us back to the Great Depression. When we were looking at, you know, back then, people were losing their homes. That's when FHA was created, you know, as the Great Depression was coming out. We were coming out of the Great Depression, but people were losing their houses. I mean, a lot of over history, a lot of people, a lot of foreclosures. We're missing that now, and part of it's just because of stimulus, but the piper's catching up. And we're going to see that, you know, pretty soon, I believe now. Let's take a look at a market here that you have pulled up. We'll show you guys. I mean, home prices are coming down, guys. It's happening.
Joe, is my screen shared if I popped over?
It's happening right before
Go over to it. Okay.
our eyes. These rates are crushing home sales. But guys, institutional buyers are ramped up. I'm going to talk about more of this in the Saturday video. I'm going to just blow you away with the data that I have. And on Saturday's release, you're just not going to believe it when I tell you what is going on. But anyway, there are institutional investors that aren't going to be affected by interest rates because it's called fractional buying. And a lot of these buyers they're standing on the sidelines. They're not even standing on the sidelines. They're buying right now. And a lot of these fractional buyers, they are pooling money together. And the only way you can do this is you've got to get through the SEC, get your paperwork straight. And people can invest in these houses. We've talked about Arrived Homes is one of them.
Right.
But they're really, we have somebody that's going against us right now and really, kind of undermining what is happening. And we're going to talk about it Saturday. But my point here is that what we're seeing in the marketplace is as buyers can't afford to buy, as affordability is going up, these investors have found a way to undermine home buyers yet once again to take these houses and turn them a finite amount of inventory, because we know the government regulates what is going on with building houses. And that's one of the reasons why builders are not encouraged to build affordable housing, is because they spend so much money getting through red tape and developing that they have to build these big McMansions in order to make enough profit for it to make sense. So they're building an average. The August data was the average new home price, sold price in America was $513,000. At the current interest rates, that's anywhere from $4,700 to $4,900 a month.
Incredibly expensive.
By the time you add in your property taxes and your insurance and your principal and interest.
Yeah.
Right.
Yeah.
Anyway, let's take a look at some of this. What do you got for us?
Tampa. Yeah. We set this to the max of the pricing, $1 million, but at the peak of this search here. But we can see price declines. So we have, the first one there, that's down by almost $300,000. This apartment, they put it down by $1, so now it hits underneath the $1 million mark.
Let me just scroll through.
Yep. And then this one right here, close to 100,000.
We're looking for the green. Go ahead.
Yep.
Keep going. So we got one green there. We got two greens in the row there. Keep going. We got one green. Right. So this is where?
This is in Tampa.
Okay. Keep going.
Yep.
All right. So what we're doing is looking at price reductions. You go to realtor.com, you check out the prices. They're falling like a rock, guys. I mean, and in the case of today where the seller said, no, we're not going to close tomorrow because I'm not going to come up off of another couple percent off of my list price. In fact, whatever it is, not list price, whatever agreed price is, I don't know the details other than I know that it's falling apart. My agent called me up and said, we can't get anybody to budge here. The buyer's been the only one that's, in this case that seems to be paying or coming up to something. And, but sellers, if you're not making deals right now, you've lost your minds. You don't want to sell.
Yeah.
Stay in your home. Stay in your home. All right. Let's move right along. Any more comments?
Yep, we sure do. Let me hop on over there. And we did have Lexi.
All right, Lexi, she's having she found a dream home, got a great deal on it, and she's got a housewarming party coming up.
Yeah.
All right, what's she have to say?
She has a question. Do you think the housing market will break in 2024 being an election year? They've propped it up this long.
Yeah, I think that we're going to see prices tumble between now and then. So I think 2024 is going to be a good time. I think interest rates are going to remain high, but I think if you're a buyer, save your money, save your cash, get as much of a down payment, improve your credit as much as you can, so that you can qualify at least at the time for the best price. Get with a loan officer. Get with a mortgage loan officer. You can find one on our website. We have one that is in 29 states or something. If you're following one of those states, but get with a loan officer and just start saying, hey, look, I'm thinking about, maybe in the spring or the summer of 24, buying a house. I'm watching the market. Get with an agent. Start your searches. If an agent doesn't want to mess with you because you're 6 months out, call us. We'll find somebody who will. But I think it's important that if you're really thinking about buying a house and you've been sidelined, we need to be very strategic at this point and help you to write some kind of a plan to get something going, show you what you should be looking for, making sure that you have your boxes, your list, so that we can see how many boxes get checked when these properties start falling, in price and more start hitting the market, because you are going to have to compete again with institutional buyers, I believe. So we want to make sure that we know a lot more than we knew last time. We aren't certainly going to let you make the mistakes that we've watched people make in the last 3 years. I mean, if we don't learn anything by history, what kind of, fools are we, right? So we have to make sure that we are prepared. So I think 2024 is going to be a time when a lot of you buyers may get what you're looking for.
Mm-hmm. We had another super cash.
I think it's going to get bad.
Yeah.
I think it's going to get bad.
I was listening to Jason Walter, and he said with current rates and home prices, you would spend an extra $367,000 about just in interest over a 30-year mortgage compared to 2020.
Yeah, didn't I podcast with Jason?
You did.
Right. Yeah, I think I commented on one of his videos because he was, and I like Jason, but he was certainly not in our camp with what we were talking about with the housing market falling out. Very few people were. Now we're starting to get people that are like, oh, geez, maybe they are right about this thing. Like maybe they do know something about the economy and the housing market.
Yeah.
And I don't want to be right. I'm not patting myself on the back, believe me. But when we look at the people that were saying that we wouldn't see price reductions and we're seeing them, when we look at people that said we wouldn't see 8% mortgage rates and we're seeing them, right? I mean, come on. So now I listened to one of Jason's. I like him. I respect him. I was listening to one of his videos and I commented and I said, Jason, are you changing your mind about the housing market? And he said, what do you mean?
Oh.
I never commented back, but I think Travis from Real Estate Mindset took it from there. But anyway.
Of course.
Sometimes Travis can be like a troll.
Oh God, that's
I
funny.
love him, but he said, and by the way, a troll is just somebody that comments something to get a reaction, right? That's what we call them in this wonderful YouTube broadcast world.
Yeah. Oh, we've got some more here.
Thank you so much, by the way, for
Thank
your
you.
super chat.
Yeah,
We
and we've got
appreciate it.
another one coming in right here
Thank you
as
so
well.
much.
Thank you. I take much flack in New York for sharing the same thoughts as Todd. I also had a Bear Stearns employee tell me I had no idea what I was talking about in late 2007. We all know how that ended. Your wisdom is priceless. Thank you.
Yeah, well, in 2005 is when we started to feel the effect as builders. I had inventory in 2005, and I mean rates. Home prices were dropping by the tune of $50,000, $60,000, $70,000, $100,000 in the 750 price range. Let's just say. And that was in 2005, 2006. It started happening with real estate agents. God bless their souls. What happened was they said, oh, the real estate market didn't get bad until 2008. Well, they weren't home builders. It was like, well, you still got paid as an agent. And, so here's the deal. I mean, 2005, housing market started tanking. It took 3 years in 2008 before we were starting to see the blood in the streets. Now, guys, the main thing here that we have to be focused on, we have to keep in mind is we had a paper, a newspaper, right? A real newspaper that you would put a 50 cents in or whatever and get a paper out of the box. It was called the Baltimore Sun. It was a paper. In 2005, they don't have this paper anymore. 2005, the headlines of that paper said the overpriced Baltimore housing market. Boom, the tank, right? That point, it was all over. But then the media wasn't controlled like they are now. You say, oh, Todd, come on, the media's not controlled. Okay, all right, well, why isn't anybody talking about this then? Why are you listening to me instead of, NBC or ABC or Fox or CNN or whatever, talking about what is going on in the housing market, right? But my point is that sales were still happening. We saw 2005, we started seeing price declines. 2006, believe it or not, was the peak for existing homes, right? New home construction falls first, folks. The reason is because nobody lives in the house. Right? So the inventory is all speculatory, right? You're looking at it, speculation. Well, can we sell these lots? We developed this community. There's 350 lots in it. There's 160 lots in it. There's 700 lots in it. We developed it. We started developing it sometimes 10 years ago. Now we're at the point where we have got our roads in, our infrastructure. We're ready to stick shovels in the ground and actually bring water and sewer to the foundation areas and start digging a hole. Well, what happens is there's a carrying cost for these builders. And, so when the market starts to tighten, when affordability starts to go away, the new home builders start to feel it first. These are traditionally second home buyers or move up buyers that are buying these. Now we're seeing the primary buyer of the new home as first time buyers. They can't afford this. They don't even know what they're doing. They just want a house. They got a good job for now. And they're diving in, first-time buyers buying $500,000, $600,000, $1 million house, right? This is never before has it happened. But my point is in 2006, it was the peak, just like 2022. By 2008, we had a complete crisis on our hands. Ben Bernanke said it would never crash. We'll never have problems with the housing market. Banking strong, never going to happen. It so mirrors. And the first thing people want to say is, Todd, but it was a different time then because you had all the liar loans and stuff like that, the subprime loans. The subprime loans weren't the problem. The conventional loans were the problem, right? It's just false information that's spread all over the place. You got to dive in and look at it yourself. But my point is with the internet now, my point with the newspaper was that news traveled very slow. YouTube, I think, started in 2005.
I know.
That's it. Maybe it was 2004, 2005. I mean, guys, we didn't have this, right? So we didn't get the information like we get it now. So these crashes or troughs, peak to troughs, happen much faster. I think it's easy to say. News travels faster. We can educate faster. We can say, whoa, faster, right? We can see what's happening faster. And I think now, so when we look at that, if 2006 was the peak in existing homes, and 2008, 9, 10, 11, and we fast forward that even a little bit, we're now about coming into a year and a half from the peak. So I think we're going to see something in 2024 where we're really going to start to see the markets take a major dip.
We had another
If people need to sell.
super cash.
The people that don't want to sell or can't sell or whatever, they hang on to their house. Apparently that's what this seller said. Well, I'll just keep the house. Well, keep it.
Keep it. My agent has been trying to get me interested on what he believes a home will be worth in 2 years from now. Bless his heart for dealing with me. He wouldn't want me listening to this.
You know, I mean, so thank you very much for the super chat. Trying to get me interested in what he believes a home will be worth in 2 years.
Right, like
You know,
forecasting.
there is a, and I'm not saying your agent's right or wrong, but I'm just saying that, you know, there are people out there that they want to buy a house today. And it doesn't matter what the prices are and the interest rate. And they're not wrong. They're not wrong. I mean, if it, you know, a home doesn't have to be for the purpose of investing. Some people just have money and they don't care. They want what they want and they get it, and fine. I'm really talking to first-time buyers. You know, when I'm really trying to caution people about, you know, overspending is because the economy is a wreck. You know, just like Charlton said, you know, lending is tightening.
Yep.
Commercial lending is gone. We're about to have a major crisis in the commercial real estate industry. We haven't even seen the pinch. They eliminated what was called as a recession, and now they're saying we might have one.
Yeah.
Well, if we didn't have one before, God help us on what they say we'll have one, because they wiped it out, right? It was like none. We had 2 consecutive quarters of negative GDP, and it was technically a recession, and they changed the meaning of it, and there is no recession. But now we're looking at it may be a recession from some of the chief economists, and one of those, by the way, is with Fannie Mae. And we'll look at. But my point is that if your agent's trying to forecast, if he's forecasting the right number and you can get it, move forward. I mean, it's, you know, I mean, I can probably forecast, you know, what I think that their home is worth. I'm looking at houses right now for clients, and I'm like, man, that looks like it's $100,000 overpriced. That looks like it's $150,000. That's $300,000 overpriced. I mean, looking at it, going, look, it's been on the market 180 days, you know, 116 days. Like, man, nobody's bought it yet. Ooh, the only one thing you can do, drop the price if you want to sell it, right?
Right.
So, you know, you can sort of, if you've been in the business and you know, nobody's going to time the market. Don't try and time it exactly at the bottom. It's not going to work. Nobody knows where that is.
There is a question here. What is the next major thing we will notice as potential buyers that will confirm we are in a downturn?
Days on market is probably number one. When you're starting to see things, and I'm seeing them already, selling agent bonus. When you see agents on the other side enticing because their seller says, well, maybe if we encourage the agent with a carrot, you know, with a $5,000 selling agent bonus or something like that, right? When you start seeing things like that, which I've seen, I just got an email from an agent that said selling agent bonus, and a selling agent means the one that brings the buyer, the procuring buyer, you know, the procuring cause, the agent that brings the buyers, a selling agent, not the seller's agent. That's the listing agent. But when you hear a term, the selling agent, that is the one that brought the buyer or the buyer's agent. But when you start seeing selling agent bonus, that is a big indication of what's happening. Instead of dropping the price, they just want to offer
How
first.
about
to try and offer.
sellers paying for closing costs? Do you think
Yeah,
that's
you're
another?
starting to see that. Yeah,
Yeah.
seller concessions.
Yeah.
Seller, credit towards a new kitchen.
Right.
When you start seeing, renovation money being offered in the description. But the biggest real indication is days on market. And let me tell you, there's all kinds of tricks to this too. So if you're looking on Zillow, looking on homes.com, whatever, realtor.com, look at the property history. Because what you'll see, like I was looking at one house for a client, and I was like, man, they've been trying to sell this house for over a year. So a lot of people, they'll take it off the market, they'll switch agents, they'll throw it back on the market 45 days later with a new MLS number, days on market start all over again. I'm like, you can't, there's a curing, period where before the days on market resets. So you can't take it off the market one day and next week put it on the market again and not see your days on market follow you, because they will. But if you take it off the market for a period of time, so when you're looking at the history of the property, you can see like, man, they've been trying to sell this daggone thing for a year and a half. Sometimes, guys, you even see a lower price. Like they were selling it for $649 back in 2022, but now they want $729. You're like, what's up with that? Did you renovate the house? Then you can look at the pictures from the old MLS and the new MLS and be like, you didn't do a thing. They're just trying to trick you, right? Because most agents and most buyers don't know to look at the data. Most agents, they don't look at the data. You've heard me ask them.
Yes.
Sometimes when I have listings, I show the house myself to the buyer and the buyer's agent. Melissa's been there a couple times, and I'll ask the agent, did you know this about the house, or did you know that about one? It was big. One, this was a concrete house, remember?
Well, I remember it happened to me as well.
We did it.
Yeah, and I.
Go ahead.
Yeah, well, I showed the listing for you, and I walked through, and
Don't say anything wrong. I can't erase this.
I know. But I met the buyers and the buyer's agent there, and I did say, it's a very special house. Did you do any reading on it?
Why was it special?
It was a concrete form,
What was it
ICF
called?
house.
ICF, there you go.
And she was like, I said, this is a very special home. It's an ICF home. It's a concrete home. Oh, I didn't know that. I said, yes. And the buyers knew it.
Yeah, buyers were right there. Oops.
Yep. And she's like, oh.
I showed it to one, right?
Yes.
Agent came through. I said, hey, did you read the listing? Did you know about the listing? Oh, yeah, I read it. I said, did you read it? You know about the house? Yeah, I'm good. I said, did you know it's a concrete house? She's like, no, I didn't know that. I'm like, it's the first line in the description. I just wanted everybody to know this house was indestructible, right? I mean, it's not normal to have an insulated concrete
Not here.
freaking house
Yeah.
in Maryland.
Yep.
But anyway, the agent didn't even know that. Then I asked a couple other questions, and their buyer's looking at me like, oh, just please save me from this agent. And I said, would you like me to show you the house? And they said, yeah. And the agent was so pissed off that she got on her phone. She like walked away as I was showing her buyers the house. What am I going to do? Got to do my job.
Nothing surprises me anymore out there. It's how it is.
Oh, but Todd, you're talking about agents. I'm not.
Oh,
Speaking
my
the
goodness.
truth about real life situations.
How about this one? So are we crashing, Todd? Or so we are crashing, Todd.
Yeah, we are. It depends on what you consider a crash. But I mean, guys, look, from 2022, we have crashed. Okay. From April, May of 2022, the real estate industry has crashed. It's going down. Price reductions are becoming more and more of a thing. Buyers are not tolerating what they were tolerating before. They're expecting sellers to fix things. That's a crash. People aren't doing escalation clauses like we saw. That's a crash. People aren't showing up at open houses, standing room only, creating traffic jams in the roadway, leading up to an open house. That's a crash. There's a lot of things that have crashed since 2022. Now, have we had a 40% reduction in home prices? No. And I don't know that we'll ever see that. And I never said that, right? What I said was originally is we're going to see a 10% price reduction, home price reduction from the peak to trough, right? And that's overall nationwide. I still believe that. We've seen that even in some markets, right? I've said that some markets may see a 15 to 20% price drop, right? But I don't think we're going to see a 40 to 50% price drop, guys. The institutional investors will never let it happen. We're going to see hyperinflation like we've never seen before, all right? It's coming. When we look at where prices are, they are not coming down. The raising of interest rates is a tool for the Fed to get inflation back to a freaking whatever range, 2 to 3%, wherever. It's not working. It's not happening. They've raised rates faster than they ever have in the history. We're looking at Fed rates that go back decades, right? It's not working. So we're going to see hyperinflation like we've never seen before. It is out of control. There's no way of reeling it back in. Now what they have to do is stimulate the economy somehow, right? Or they have to encourage these businesses, which would be stimulating the economy, to pay their employees more. How is that going to happen? So the economy stinks, buyer demand's down, interest rates are up, debt is strangling people, right? We've got credit card debt, auto debt like we've never seen before, delinquency rates that are coming up. If we don't look at it and say that prices have to come down, the only difference now is that we have fueled real estate investors to a point to where they are on the sidelines with money. I'm telling you guys, these investors are ready to buy single family houses. It's already said that 1 in 4 is owned by companies in the United States. 1 in 4 single family houses. Let's move on. I want to show you guys something. Joe, I don't remember which one it was in. What were we looking at? We skip over Fannie Mae here for a minute. What chart do we need to be in? Maybe you could just pull it up. I want to show you guys some of the stats on, where are you, Joe? On investors. We'll come back. Here we go. Institutional sales right after the CNBC. It may be CNBC. Here we are. Yep. Let's do the CNBC article right here. And I'm going to show you guys the inverted yield too. I mean, we are in such a freaking, by the way, the 2-year treasury is now paying more money than the 10-year treasury. The only time this has ever happened in history, excuse me, is when we had recessions. It's coming. Here we go. Let's go over the CNBC article here. The CNBC article, just to back up what I'm saying, Wall Street has purchased hundreds of thousands of single-family homes since the Great Recession. Here's what it means for rental prices. Corporations backed by private equity groups such as Blackstone and Pretium Partners bought tens of thousands of homes across the U.S. Sunbelt. Prices for detached homes have increased faster in the key Sunbelt states than the national average. Institutional investors do not yet control a large market share in housing, but analysts writing at MetLife's investment management suggest they could by 2030. Institutional investors may control 40%, I think that's low, 40% of the U.S. single-family rental homes by 2030, according to MetLife Investment Management. And a group of Washington, D.C. lawmakers say Wall Street needs to back away from the market. Let's look at the next slide here. The top 10 U.S. housing markets with the greatest share of institutional investor sales. Guys, this is 10 markets in the U.S. where investor shares have been over 15% of the houses that have been bought have been institutional investors, right? Next slide, single-family home investors' share remain high in Q4 of 2022, right? Figure 1, share of home purchases made by investors by month, January 19th through December of 2022. Guys, when we fueled this, right, we fueled this market. So look at this. I mean, right now we're at 26% of houses purchased by the end of 2022. 26% were made by investors in the fourth quarter. Or no, this is, fourth quarter, but this is over several years. Next slide. Institutional, and by the way, I mean, this is from the National Association of Realtors. This was in 2021. Look at this chart dating back to 2000. Look at the percentage of institutional buyers buying up single-family houses. Yes, it declined a little bit in 2021 and 2022, but that's just because interest rates went through the roof. Credit was tightened for these investors. But guys, here's the thing. This new wave of buyers is called fractional buyers. They're pooling money together. Let me tell you, the rental property in your neighborhood may be owned by 100 people, 100 different people. It may be owned by 1,000 different people, right? They are buying up. They are pooling money. Some sites you can invest as little as $100 or as much as you want. Some sites have a minimum of $5,000 buy-in, right? But they are preparing groups of people to jump into this market, to buy up all of the inventory that comes available so that you have to rent, right? And this is affecting the middle class. This is affecting the middle class. Why is this happening? I'm going to show you on Saturday. It's going to blow your mind. I don't think I've ever led up to a video like that before.
No. This is like...
It's one to mark your calendars for, I promise.
Yeah. And that's all we'll say about that.
That's all we'll say about that. All right. All right, let's go ahead and take some more questions.
Yeah. So we have, bear with me here. Here it is right here. Okay.
I don't know where my link, I can't even look along with you.
I have been following my market in the Tampa area and noticed that a listing was listed for 180 days, originally priced at $330,000. Relisted a couple of times as pending, fell through. Now they have increased to $400,000. The reason for that?
Yeah, well, maybe they did work, like I said. I mean, a lot of times what'll happen is, and this is crazy because, and a lot of this is the agent, right? A lot of this is the listing agent. So if they change listing agents or what have you, but
Right.
you know, what happens is, you know, let's say I have a listing, a client, and so we are, you know, we're putting their house on the market. Joe, I've lost my connection again here. Here we go. All right, I think I'm back up. You have a client and you go under contract and they have a home inspection. They come through and they say, well, the septic's bad. And they have a house with a private septic, and a septic costs $25,000 to put in. It's not cheap, right? What'll happen is the sellers will be like, oh, well, I want the $25,000 more for the house now. And you're like, well, depending on who the agent is, the agent might be like, okay, that sounds good. We'll put it on the market for $25,000 more. A good agent's going to come in and say, dude, you can't sell the house without a septic.
Right.
I mean, you were selling it the first time thinking that the septic was going to pass. There's no like somewhat. It's either passed or failed, right? So what happens is they go, well, because I spent $25,000 more, I want $25,000 more for my house. Doesn't work that way, right? Same thing with like fixing electrical issues or fixing plumbing issues. Like, well, if you fix those issues, it's because the house needed to fix. You can't say, well, now I'm selling the house with a working toilet. Well, now I'm actually selling the house with a working HVAC system. So a lot of times, you know, the things that they spend money on aren't constructive. It doesn't increase the value of the house. But sellers, they get this in their mind that if they updated something, then it should be worth more money. I've never seen a house become worth more money because its roof was 1 year old versus 15 years old. The roof either passes or it fails.
Right.
Now, the roof may be in its last third. That's what they say with roofing, first, second, or third of its life. It could be in the third of its life, but that doesn't necessarily mean they could ask for a new roof or credit towards one, but it doesn't mean that they're going to get it. And it doesn't mean that the house is worth more money because it has a roof that doesn't leak.
Mm-hmm. We have another super cash. Another dropped 60,000 after 30 days. So I'll wait till next year or until something breaks. 1,200 plus square foot homes are coming on the market around 300,000, but those damn rates are killing my affordability.
Yeah, and thank you so much again for your super chat. So, I mean, so let's look at it. I mean, if we're looking at a $300,000 house that's dropping 60 grand, I would try and find a way to probably buy it. It depends on what market it is, but when you're looking at houses in America, there isn't a whole lot. And if it's a detached house that you're going to find that is in a place where you can find good jobs and opportunity, that's going to be less than that. When you're looking at, 1,200 square feet, maybe you're 250 a square foot. It might come down a little bit more, but if you're seeing $300,000 houses drop 60 grand, it's probably, unless the nuclear plant is being built right across the street in the next couple months, and you should check that out. It may be, 20% off.
Yeah.
Unless the 300 was just 100% too high.
How about this one?
But interest rates this is by design.
Yeah.
I think. This is by design. These high mortgage interest rates, let me tell you something. I don't know what it's accomplishing. I know why it's happening, but 7% is not a high mortgage interest rate. We need to see 12%, at least 10, 11, 12% mortgage interest rates to where we can say mortgage rates are out of reach. When we're looking at 7.5% mortgage rates, that is not a bad rate. People don't want to say it, but the only reason it's a bad rate is because the home prices were too high.
Yeah.
So now it's a race where get used to the interest rate, I feel. Get used to the interest rate because the Fed's not buying mortgage-backed securities. Mm-hmm. So what happens when they're not? They're kicking the mortgage-backed securities to the investor market, the secondary market.
You mentioned 12, 13%. Do you see the rates?
I don't think they had the guts to raise them to that.
Yeah.
I don't think so. Let's look at, I'll try and find something here. There was a article. Let's go to the Housing Wire article, Joe. I want to talk about Fannie Mae because a lot of people, they hear Fannie Mae, Freddie Mac, these government-sponsored entities. They're quasi-type companies, government companies. They don't buy loans, but they insure the loan. A lot of times when you go out and you get a mortgage and you don't put down 20%, you have insurance that kicks in, PMI insurance, and it's very expensive. But anyway, Fannie Mae, in this Housing Wire article, I'll give credit to Housing Wire. This is something I'm a subscriber there. It's not something that you would get access to unless you had a subscription. But Fannie Mae and Housing Wire, they really do a good job of keeping us up to date in the industry. Fannie Mae's chief economist on the housing market outlook, and just want to kind of, my highlights are gone. But I guess what I want to point out here is, do you have highlights here, Joe? Or don't you just share it?
Can you go to, if you go to the StreamYard link, you're going to be able to see it.
Yep, I don't even know where the StreamYard link is. Guys, I'm not very tech savvy.
It
So.
looks like a little horse or duck.
Looking for a duck. All right. One of these days I'll get good at this.
And you can make it larger. Yeah.
There we go. All right, here we go. Housing Wire. Federal Reserve effort to temper inflation has cooled the housing market that remains subdued with mortgage rates north of 7%, while the central bank left the benchmark rate unchanged in the target range of 5.25 to 5.5 this week. Fannie Mae chief economist Doug Duncan believes that mortgage rates will stay elevated before the Fed makes further rate cuts. Now, keep in mind, these guys have a little inside, I believe, knowledge as to what's going on. They insure mortgages. If they're saying that rates are going to stay high until the Fed makes cuts, I think it's pretty fair to say that. But anyway, with the majority of Fed officials expecting another rate hike by year end. So we had 19 people voting on rate hikes or no rate hikes at the Fed level, right? So I think it was 7 said rate hikes, 12 said no rate hikes. We still have those 7 out there that said rate hikes. And they said, well, let's just wait and see what happens. We're looking at backward-looking data. We are seeing some softening in the market, how August inflation went up. But anyway, they said, let's just hold off. I mean, why don't we really say, but guys, we really can't crush the market yet because we're in election year. But we know we still have work to do. We still have a job to do. But anyway, Duncan predicts a 50-50 chance that they'll raise rates again one more time. I personally think they will. I think we're going to get another 0.25% rate hike. But anyway, elevated mortgage rates will lead to more lenders spilling red ink in the latter half of the year, in contrast to improving financial performance of independent mortgage banks in Q2. So goes on to say, Doug Duncan, he was asked a couple questions, and I think there's a lot of insight or value to what he says. He says that it's our forecast they won't make another change until they drop rates. I think the forwards suggest that either November or December, there's a 50-50 chance to make an increase, right? I would say the risks are tilted that way, but we don't have it in our forecast model. We don't have the Fed dropping rates until the end of Q2 next year, and we have a mild recession that starts in the quarter. Well, my gosh, if we haven't seen a recession and now we're talking about a recession, that's scary, right? And then it goes down. Kim says, well, spreads in mortgage space are wide. What are the reasons for that? And Duncan says there's several reasons for that. If business flow for a time period helps them cover the variable cost, then it can be effective. But it gets into, let's move on down. It also is the case that the Fed is running its portfolio off. So what this means, guys, is the Fed is getting out of mortgage-backed securities. They're the only ones that made interest rates go as low as they did. If the Fed wasn't offering 4% mortgage rates, they wouldn't have happened because investors want more money. And that's what he's saying here. So it says that they're burning off their portfolio, but somebody has to replace the Fed. And the Fed is not an economic buyer. That is, they weren't buying for risk return metrics. They were buying to affect the structure of markets. So they're a policy buyer. So what this Duncan guy is saying, this economist for Fannie Mae, who knows what's going on, he's saying to us guys, he's saying, look, the Fed doesn't worry about risk. They don't care about the risk. They care about moving markets. Investors care about risk. So when you're asking an investor to take over the mortgage market, the secondary market, the banks are going to sell the loans because the banks want to make the money. When you apply for a loan with a bank and you get a letter in the mail that says your loan's been sold, that's because the bank wants to free up that $500,000 that they just funded for the house purchase. They want to free that money up. So what they do is they keep origination fees, and a lot of times they become the servicer of the loan. So, you get the statement from that bank maybe, but they've sold it to a secondary market. Fannie Mae's, in a lot of cases, insuring that loan. And basically what happens now is the bank makes money off of sending your coupon or your statement or getting your money and paying the principal, the interest on the note to the investors, and then paying things like your property taxes, your insurance, and things like that. The servicer, that's what's called a loan servicer. So residential banks, not commercial banks, but residential banks, they don't portfolio your mortgage when you buy a house. They sell it off. So what Duncan is saying here is that the Fed was buying those. That's why we have mortgage-backed securities on our balance sheet. The Fed is saying we need to do quantitative tightening. What they mean by that is we need to get rid of this debt. that we have that is very cheap on our books on all this money we've tied up, right? So what they're saying here is, what Duncan's saying is, look, these investors aren't going to offer these cheap rates that the Fed has. But anyway, it says, then Kim says, interviewing Duncan, a bit of good news for lenders in Q2 was that their production volume went up and origination costs went down. Are you optimistic this trend will continue? What Kim is saying is that, the lenders had a little spike because rates dipped a little bit and people locked in for their home sales. We're looking at backward-looking data. And Duncan says, if rates stay 7.25 level, it's going to be worse, not better. Okay? So here's what we're looking at, guys. Interest rates are going to stay where they are and go up. Mortgage rates are not, in my opinion, are not coming down anytime soon. So that is going to rock the housing market. And now we're going to watch house prices come down. So let's talk about what's better. Is the drop in home price better or a drop in mortgage interest rates, right? I'm going to tell you over and over and over again, it's better for home prices to drop for you than it is for your interest rates to drop. Now, people will argue the fact that if we have hyperinflation, today's home prices are a good deal, lock in on a cheaper mortgage. The problem is if we don't see home prices appreciate and you're buying now, the only savings, and by the way, in the history of real estate investing, buy low, sell high. It's in every book, every author's publication, anybody that's made billions and trillions of dollars in real estate. I don't know if there's trillionaires out there in real estate, but billionaires, they're going to tell you the best thing you can do is buy low and sell high. So what we're trying to do for a lot of the buyers is say, look, you're in a position where you can wait a little bit. We think that sales prices are going to soften. Let's see if we can get you some equity on the front end of your buy. We haven't been able to do it in the last several years. So now let's see if we can't get you into, a savings for that house. Because a lot of people are only staying put for 4 or 5 years, or some cases 2 or 3 years. They're buying a house and already they're getting job transfers and they need to move. If you pay top dollar or overpriced for your house and you have a great interest rate, that's not helping you out at all when you go to sell, unless you have an assumable loan, and you probably don't. And so what's happening if you're VA, yes, but you speak with a lender because, you might be tying up your opportunity to buy again. I don't know. But what I'm saying here is if you buy right, you're going to be in a position where you can have some liquidity to have the freedom of selling the house once the market starts to improve. I don't think we're going to see huge price appreciation for 10 years. So if you're not going to stay in the house for 10 years, price is important, not the interest rate.
Had some comments while you were explaining all of that. I just wanted to hit on these really quick. Fed will not drop rates until the earnings on corporations are starting to fall and layoffs are happening. Then we had another comment. When everything fails at once, the everything bubble, it doesn't matter what is too big to fail. It all collapses.
Yep.
And then the final one here, rates have to go to 13%. Years of low interest is like eating ice cream for dinner for years. We must pay for the sins of the Fed. I don't make the rules. I just pay dearly for them, as do you.
Yep. Let's pull up a chart here, Joe. Statista, number of existing homes sold in the U.S. from 2005 to 2023. Just want to take a look at this because what Duncan was saying, and also in that interview, was that we were at an all-time low of home sales. This is an indication too of something is happening in the economy. We've got, they're saying that sometime this year, this is adjusting because these are year over year, predictions of where home sales is going to be in 2023. Some are saying that it's going to be somewhere around 4 million, not 4.3 million houses. That will be the lowest that we've had, even dating back to the financial crisis, where, home prices were falling drastically. And I think one of the reasons is because the investors are on the sideline. So they're waiting for prices to soften, and then we'll start seeing the number of home sales increase as they're gobbling up inventory. If we look at new home sales with trading economics here, there's a couple things, we can look at and see when they're talking about, we have new home sales that are down, inventory that's down. We actually have inventory that's up, right? There's a lot of, I think we're like at 1.2 million in inventory of new home construction. In some cases, we're over 6 months supply in certain markets. That's certainly a buyer's market, but these numbers are in thousands. So that's 675,000 homes in August that sold new home construction. And I just want to kind of take a look to show you that new homes, the builders are actually starting to take price cuts. And so I just pulled up Lennar here, and I'm kind of surprised because I might not be surprised after we talk about Saturday's video. But, when we see Warren Buffett has invested $700 million up thereabouts in new home builders, and Lennar being one of them, this is some of the deals that you can see if you go to Lennar's site. This is Florida. Buy new and buy now. Pay zero closing costs on select homes, excluding discount points. Here they say, discover some of our best deals of the year on select move-in ready homes during our new home national sales event, right? Goes on to talk about that. When we can go to Lennar, same builder. Here we're talking about Dallas, Fort Worth. Same thing. National sales event happening now for a limited time. Take advantage of Lennar Mortgage, 4.5%, 5.27% APR. FHA fixed rate up to $6,000 towards closing costs, blah, blah, blah. Right? Here we go. Lennar again. This one is, where's this? Vegas, Las Vegas. Take advantage of our incredible fixed rate of 4.99%, 5.022 APR at select communities across Las Vegas Valley. Right? Clearly, we are starting to see, and I could go on and on and on. I can dive into all their all their inventory and show you prices are coming down.
We have another super cash. Thank you very much. Buffett is heavy with home builders because I think the you will own nothing and be happy agenda is on its way.
You need to watch Saturday's video. It's going to blow you away.
Making home builders and their infrastructure very valuable. I may also be very wrong.
I don't think you're wrong. I don't think you're wrong. I don't think you're wrong at all. I think, the more I'm looking at the evidence, the more I'm seeing how, they don't want people, whoever they are, to own houses. Yeah. It's actually very sickening. How about this? Let's look at this, the current Treasury notes. The 2-year Treasury note, guys, today, 5.059% on Market Watch here. This is how much the government's going to pay you if you go invest your money into a 2-year Treasury note. The more disturbing is when they talk about inverted yield. Actually, the 10-year Treasury note here, guys, pays you less. So the 10-year Treasury, 4.529%. It's crazy. Mm-hmm. Did we show where mortgage interest rates were?
Not yet.
No. Anyway, so here's the question. The government needs money. So why would they pay you more for investing for less time? That's the big question. So every time in the history of the U.S. economy, we are seeing recessions when this happens. So I think we're ready. Mm-hmm. I think I'm offline. Let's show that where mortgage interest rates are, Joe. Because, a lot of people are like, well, mortgage interest rates hit 8%. Here we go. 30-year fixed rate here in Maryland, $300,000 loan, 20% down payment with a 700 to 719 credit score, 8.2% today. Average rates. But let's drop that down to we know that most of America has rates that are credit scores that are lower than that. So what happens when I've lost connectivity? Want to share that big screen television you have?
Sure can. Sure can.
Did you want to do 600?
Yeah. So,
Yeah.
no. Yeah, I think it might be less because, but sure, why not? Your data says not available too. Are you offline? Are we having, is the Fed kicking us offline?
Are we still
All right.
hooked up? Okay.
Well, Melissa and I have been disconnected.
Yeah.
The Fed has said, you guys have said enough. The Fed
about-
has said,
Go to like 620, Joe. Yeah. Click that and see.
hey, wait
there
a
we
minute,
go.
it came back.
Yeah.
Yeah, I mean, 8.23 or whatever, 8.76.
8.76.
Right. I mean, and look at that. That's crazy, isn't it? So if you got, I don't even know if you can get a I guess maybe lenders can do 620, 639 credit score. I don't know.
I think they're doing anything creative right now to be able to get people to purchase. So, yeah, I think you can. Joe, can you help
offline.
him really quick?
Anyway, let's
Get
take
back
some
on?
questions.
Let's take some questions. I'm going to get out of the full screen. So I can
This is
see
what you guys get when we have live
live
shows. I mean, it's
shows.
it's-
This is it.
This is it. This is really live.
It's
Is it
really
Are
live.
these guys really live?
Yeah. But we do have a question here. How about this one, Todd? Do you think people will get their property taxes lowered if houses drop in value?
Yeah, but they need to drop in value, and the tax assessor, you would have to fight it at that point. But that's what happened when we had the 2008, to 2012. There were actually businesses that started up that were like, I can save you money on your property taxes, and you don't pay us unless we're successful. And they were sending those out to homeowners all over America. And, so it was a new kind of business that, popped up. But, a lot of people, am I online? You don't have our stream pulled up. But a lot of people, look, I don't know, man. I think we're in a worse financial position than we were in 2008. I really do.
How about this one? Are there a lot of institutional investors in Maryland?
They're buying properties everywhere. I mean, you're talking about large conglomerates. The big thing that you have to start looking out for, guys, is this fractional home buying. And that's basically where, buyers, you as a consumer, can invest in a home. And they're kind of making it like, hey, this is fun. Invest in a single family house or invest in an apartment complex or whatever. Invest as little bit of money as, you want or that they set up. And, they're making it seem like this is a great thing. Well, I mean, a lot of these companies that are doing this, they have management arms. So they're making money on managing. They're making money on setting up your entities. There are fees that are involved. There's a lot of, this is a clever way of gobbling up, single family houses without using the bank. And if you're a mortgage lender, look, you might think, like your job is secure. You're just going to wait it out. The more these companies start buying up houses, the less you're going to get mortgaging first-time buyers. It's going to become more difficult.
We had this.
Hey, it looks like I'm back up.
There you go.
That's great.
We had Deborah here. I absolutely need a good agent in Kootenai. I probably am really
I think you said it right.
You
That's
think
how
so?
I would have said it.
All right. County in Idaho, mine listed too high, then had me reduce price and add appliance incentive on top of paying part of closing cost. I finally let him go. Help.
Yeah, send us an email. Send me an
Mm-hmm.
email. TS at Sachs Realty. I got somebody for you.
Mm-hmm.
Yep. I have a great agent for you. The let's just talk about that for a minute, because I don't know if you're offering appliance. I mean, if your appliances are working, now if the appliances aren't working, I'd say replace the appliance. I mean, how cheesy does that sound in a listing for an agent to say, "Hey, buy this house and we'll give you new appliances"?
Well, it sounds, I hate to say it, desperate. It just sounds like,
I mean, look,
I don't know.
There are ways to sell a house. I mean, there are ways to market a house and sell a house. And I have news for you. I mean, some of the things that we do to sell a house is we advertise on a national level. A lot of people only put it on the MLS, and what happens is when an agent does that, what happens by only putting it on the MLS, you say, well, Todd, you're only putting it on the MLS. I mean, well, it goes out to millions of, hundreds of millions of people because of the World Wide Web and it's the internet. But here's the problem. The problem is, and this is a key for you sellers, the problem is this. That's only when people are looking in your neighborhood or in your area, or they're putting in a city search. You don't know how many people that are relocating a domestic migration to, let's say, Maryland. They don't know what Phoenix, Maryland is. So if I put a home on Zillow or on the MLS and it is populated across the platforms, it only affects me when people are looking for homes in Phoenix, Maryland. However, 2 or 3 cities over, maybe they're looking in Garrison Forest, right? If I can, and they're in California, they're like, well, I'm moving to Maryland. There's Garrison Forest, and then there's Phoenix, Maryland. My house is in Phoenix, Maryland. How do I tell that California person that my house is available and it's close to Phoenix? I mean, it's close to Garrison, right? I have to nationally advertise it. I got to do overviews like, this is the area. If you work at these employers, if you do this, if you do that, if you're looking to move to this metropolitan area, this house is close to Baltimore, close to DC, I have to reel them in many different ways. And what happens is a lot of the agents just don't spend any money in advertising. Back in the day, and I'm not going to talk about commissions, but back in the day, man, we used to have to spend money on everything. We didn't have Zillow, right? And when we did have Zillow, you had to pay to be on it. You had to pay. There was something called Real Estate Book. And they came out with this digital package that got you on Bob Fila and this old house, right? He had this little, homes for sale digital website so you would buy a package, an internet package when it first came out, and then they would broadcast them to Better Homes and Gardens, Bob Vila, all these things, Zillow. They would be aggregated. We had to pay for it. Now it's free, right? But agents think that that's the only way to do it. Let me tell you, if you're an agent listening to this, those ships have sailed. If you have a seller sitting there saying, what are you doing for me? Why aren't you selling my house? One of the reasons is probably because you don't have enough eyeballs on it, right? Because the market is down and now you need to expand your reach. So that's a different podcast altogether on, if you're selling your home, because, I mean, you can be very effective in getting top dollar. I know as a buyer, you don't want to hear it, but we still get our sellers, all the money.
Mm-hmm. My internet was acting up, but now I'm here. Okay, so how about we do this one? Todd, how can fractional home buying keep up the yields while taxes and insurance are rising and pay for the whole management side?
Yeah.
They are using people for funding, is my opinion.
Yeah, well, so they are. They're using people for funding, but they will. Some of these sites claim that they get the best insurance rates because it's quantity of scale, right? So they get their management fees, but what they're planning on, guys, is hyperinflation. I mean, what they're planning on is that that we're going to see skyrocketing, inflation, and that what they paid today for the home price is going to be a bargain. Is what they're banking on. They want to scarf up as much as they can. So if they can take 1 in 4 owned by institutional investors and take 1 in 2 owned by institutional investors, they're going to own the market, right? So the value of a home, of a rental home, goes up based on the amount of rent that it can get. So when you have to pay outrageous rents to live, and it becomes hyperinflation, if you want it, you're gonna pay for it, and you'll figure out how to have multi-generational housing renting than you will buying, because that's the only way that you can. One of the only ways that a middle income family can afford to have a single family house. It's the whole. I think it's this whole. Rent and be happy. It's the World Economic Forum. It's the forces are coming together. It's happening. It's moving fast. Mm-hmm. Some people can say, well, you're a conspiracy theorist. Look, I'm just telling you, it's unfolding. It's unfolding. Look at it. I mean, I'm not making these articles up. And for every article that I'm talking about, we don't even know half of it, because I'm looking at the same articles that you can find, right? When the National Association of Realtors comes out and says 1 in 4 houses are owned by institutional investors. When we see that areas in Texas, for instance, 40-some% of them in 2021, the sales were to institutional investors. When we see whole communities being built, a finite amount of product being built as investment communities, rental communities. When we see companies touting buy into long and short-term rentals, this is just ramping up. This is getting hotter. It's getting funded. These companies are getting funded. There are bills on the table where legislators are trying to scream, we need to stop this. I don't know how they're going to do it. Mm-hmm. I don't know how they're going to do it. There's too much lobbying going on. There's too many power hitters in play.
Yeah.
And they have an agenda, in my opinion. Yeah. I could be wrong, but it's happening.
We had,
and I don't think they want mom and pop landlords. They've pushed them out. I mean, they're weaponizing, tenants against landlords. I mean, I'm going to do a video next week on that, where it's written in, on whitehouse.gov. It's talking about how landlords can unionize against how tenants can unionize against their landlords, basically. I mean, it's craziness. Why you would let tenants stay rent-free and treat you. First of all, the government isn't bailing out landlords like they bailed out the banks. So how you can penalize a mom and pop business that has a rental property and say that your tenant doesn't have to pay you and you have to still pay your mortgage payment is insanity. I don't need to think about a conspiracy theory to know that that's nuts, right?
Yeah.
I mean, mom and pop landlords can't sustain that.
No.
When they're making $400 a month and their insurance went up and their repair costs went up. Crazy. They couldn't even get things repaired.
That is crazy. It's not right.
Oh, but you can stay there and you don't have to pay. And now it's going to take you 7 months to get them out.
It's crazy.
Because you're the bad guy.
Yeah.
Not the one that's not paying the rent. You're the bad guy. Because you made a place for them to live.
Yeah.
My computer's been hacked.
Let's hope not.
You're gonna have to feed the comments.
That's fine. We'll continue.
Todd's computer's been
We got
hacked.
this one. Todd, guys,
Somebody's controlling my computer. Wait a minute. What's happening?
Guys like Kiyosaki and Ken McElroy are not happy how these institutions are buying up homes. It's socialism and it's not good.
I think Robert Kiyosaki wrote the book on buying investment properties with his book Rich Dad Poor Dad, which I like Robert Kiyosaki, and I do like Ken McElroy too. I think they're partners in writing books and stuff. They've co-authored a couple things. Ken McElroy and his wife have a show.
Yeah.
I don't know if they're happy or not happy. Maybe they're not happy that they're not. Maybe they're not happy that they're not getting some of the houses. But I don't think we're going to stop it. I don't think we're going to stop it, guys. I hate to say it. I mean, I don't know where the end is here. But I mean, if we go off of what it's like in Canada, I mean, their homes are so expensive. And I mean, it's cheaper to rent than buy. We're starting to see that in a lot of markets here in the U.S. When that's happening, something's not right. But yeah.
Mm-hmm. We had another comment here, which I was going to get to earlier, but I want to follow back up with it. Not smart, common sense. Have plenty of friends that bought in the past 2 years. House poor. House literally owns them on making those payments.
Yeah. I mean, this is what I'm talking about. We're going to see so much of this. And I mean, I'm having conversations with people that are like, they're strapped. I mean, they are broke.
Yep.
Living paycheck to paycheck, and they're $700,000 in debt on a mortgage. That's crazy.
It's crazy.
Right? And they're like stressed out about it. And a lot of people some of the people that I'm talking about, they're like, we want to have a family and have kids, but we can't afford to have a kid. So in a lot of cases, it's causing them to not be able to achieve their life goals.
It's sad.
Yeah.
It's sad and scary.
The runaway train of home prices is a result of controlling supply.
Yep.
Not getting supplies through. I mean, if you remember during the pandemic, we had ships sitting out in the ocean off the coast that had supplies that we couldn't get in because there was nobody to unload them. And I mean, I don't get it. I don't get it, right? And the big thing we haven't even talked about tonight is China is doing horrible. And, everybody's so proud that we're a world economy. Well, I mean, they're the two largest economies in the world are China and the U.S.
Right.
Right? And China's tanking. Their real estate market has crashed. Their housing market has crashed.
Yeah.
Their commercial real estate market has crashed. And that's going to affect us. That is going to be compiled on what we're in right now. Hey, Joe, let's show how lending is dried up. I want to show you guys something, man. You're going to flip out when I show you this. Because here's the thing. Everybody's touting that our job market is strong, okay? And I'm not wishing job loss on anybody, guys, but I think we're going to see massive, that's it. We're going to see massive unemployment here because companies can't afford to operate. And what's happening is the lending is dried up. And this is really freaky. So let's look at this chart. So the first thing we're going to look at with this chart is let's look at the year, which Joe's got pulled up here. And what I want you to notice is in just the last 12 months, guys, available lending credit from commercial banks has gone into the negative. I mean, really bad. And what I want to do is I want to take this to the max, Joe. And this has only happened one time since 1970s, where available money for businesses, commercial credit lines for businesses has only happened twice in the U.S. economy since the 1970s. And that was in a great financial crisis. Joe, let's just take that 1973 and let's make that 2005. There we go. All right. So look, as we were cruising along, right, till we got to 2009, right? Then it happened again in like 2011. But look at this, guys. This is what when what we're looking at here, what we're talking about is when businesses can't get loans. Let's talk about, you've got winter coming up. A lot of businesses, they rely on credit lines to get their inventories up, right? So that they can buy the next seasonality of goods, product and goods to help consumers. Well, what happens is if they can't get their credit line, oh, you had a $500,000 credit line, but now it's $50,000. Now it's $100,000. We're not going to extend that to you anymore, right? When we start seeing shrinking credit lines like this, and like Charlton said in the beginning of the podcast, when we start seeing banks tightening and not lending, this is going to hit businesses the most. Local businesses, right? They're going to start laying off people because sales, they're not going to be able to fulfill sales. So when you're looking, if you're that business that's counting on seasonality sales and you can't buy the next season's inventory because your credit line is dried up, you can't make money to keep the lights on. That coupled with the fact that a lot of these businesses aren't paying their commercial rents. They're delinquent, right?
There was a question on the
That's
commercial
scary.
side. It is scary.
That's scary. So when we're talking about this stuff, man, guys, this is real, man. This is real. And then some people pop off and want to say, well, real estate prices aren't dropping in my area. You're wrong. Okay. We'll see how long we can continue along the path that we're continuing with all of this data that's right in front of us with not seeing some kind of a major downturn in front of us.
Right.
Right. Somebody said today, hey, I bought my house, I was able to get this phenomenal interest rate. I saved a lot of money on my purchase. That's great. That's great. But it's not the norm. It's not what we're seeing. Anyway, let's take some questions.
What is the foreclosures status?
Well, I guess we'll really find out in November when the stimulus for COVID-related, bailouts end. I mean, you had the American Housing Rescue Act, or the American Rescue Act, sorry, that Joe Biden put into place in 2021 in July when the mortgage moratorium, sort of like, hey, student loans are going to start being due, but not really. Student loans are due October 1, but we're going to give you a year to ramp up and actually pay it. And we're not going to let the creditors ding your credit because you haven't been prepared over the last 3 years. I mean, we've been telling you that as of October, well, they can't do that because they can't get votes. So what, all these people, I had so many comments. My kids said they're not going to pay their student loans. Screw that. They're not paying. They don't care if it dings their credit, destroys their credit, ruins their credit, whatever. They're not paying. I can't convince them that they got to pay it. They're like, but Mom, I just can't afford it. Well, you've had an opportunity for the last 3 years to pay it interest free. But a lot of people held out because they were promised, or they thought that they were promised that they weren't going to have to pay it at all. And then they came out with something, yeah, but if you're in your mid-30s or you've been paying for 30 years, or well, you can't even follow the crap, right? But here's the thing, and people they get mad because I don't like bailouts. I didn't take PPP money. The fact is that mortgages have been bailed out. If we didn't have bailout on mortgages, we would be worse than the great financial crisis of 2008. The people that said, well, things are different than they were then, believe me, over 1 million households have taken advantage of some type of loan modification. There's a whole bunch of other people right now not paying their mortgage, right? In some kind of forbearance. White House doesn't want foreclosures, obviously. They've loan modified, FHA and VA loans. They've extended them to 40 years if you're in financial hardship. They've taken 30% of your mortgage balance and removed it from the loan. A lot of people don't realize that. 30% of your balance, if you're in default, you're having a hard time paying your mortgage, they take 30% of it and they cast it into a second mortgage, interest-free. They put it on the back end of your 40-year mortgage now, and that's a 30-year bill that just got reduced in your monthly payment. Thank you. So these modifications, it's just kicking the can down the road for many people. They're still going to get foreclosed on because they haven't been fixing their house, and it's going to become unlivable because their heating and air system is $25,000 and they don't have the money to fix it. But their mortgage has been, they have a forbearance or some kind of workout. And if you're going through that and you're having a tough time, I'm sorry, it's terrible. I really mean that. But what I'm saying here is this is why we're not seeing foreclosure rates, right? We're being bailed out. Once that starts catching up, that is going to be the distressed inventory that people are waiting for. It's not necessarily going to help out an average buyer that doesn't want to work on a home. They want to move into something that's move-in ready. That's where we see 40, 50, 60% discounts because there's mold growing off the walls 4 inches and, nothing works. And it rains inside. The office that we're in right now used to rain inside when I bought it.
I know. And have bats.
And there were bats that was flying
As
in and out.
well.
My electrician buddy told me that he was pretty sure he saw Damien leave when he was waiting one day. I just bought the house. And it was on a Saturday morning and bought this house. We converted this house, over 100-year-old house, into commercial. Went through the whole rezoning process. And but I bought the house in 2013. And I drove by the place 1,000 times. And it was caving in. The roof was caving in. The floor was caving in. And I think I bought it for $335, maybe $365. I don't even remember what I paid for it. Tons of equity in it now. And we've built on and we've done some great things. But my point is that it was in bad shape. So my electrician buddy, it was a Saturday morning, I'll never forget it. He's sitting out in front of the parking lot and he's wondering where I am because I'm running a couple minutes late. He said, "Where are you?" I said, "I'm 5 minutes away." He said, "Well, good." He said, "Because this is freaky sitting in this driveway." At the time, it wasn't a parking lot. I said, "What do you mean?" He said, "Well, I've seen bats fly in and out." And he said, "And I'm pretty sure I saw Damien." And but anyway, it was pretty wicked. And, it was kind of neat. You walked up to the, staircase and the floors were sideways and falling in and all that stuff. Anyway, enough of that story. My point is that's where the deep discounts, this was easily $1 million property, right? Where it is now it's well worth, our whole property is probably worth $3 million. But we've added on a lot and spent a lot of money too. But my point is that we've got equity because we bought it in a very distressed state of condition, right?
But here's my question. So, the government has been helping, whether it be to put the moratorium on people not having to pay their rent. And then you have all the help and the bailout with the mortgages. And then you have the student loan. So if all of that, I feel they're kind of like trying to have this crash not happen. If they stop it all, it's going to be disastrous.
I don't think that they can help it all. That's the problem. And I've always said that. It's like, I get it. And I'm not picking sides. I think the freaking politics, I don't like politics.
Mm-hmm. Yeah.
I always said part of the problem with the system is a two-party system. And now the right hates the left hates the right. It's a mess, right? And, I don't know that one's better than the other, guys, to be honest with you. But my point, is that I don't think that we can continue to prop things up.
Yeah.
Especially now that China's collapsing.
Yeah.
Are we going to bail them out too?
Oh my God.
We're fighting. Oh, I don't even want to get into that.
We're not going down that road. No.
Meanwhile, we've got people that can't afford roofs over their heads, right? We have an issue here in America where home ownership is being threatened worse today than it ever has, that it will no longer be the American dream. And we have agendas that are on the table that are helping and assisting these institutional buyers buy the single family houses in America. And we have nothing that I've seen being done about it. We have nobody stopping it. We have no groundbreaking that I'm aware of affordable housing, at least here in Maryland. I see nothing, no evidence of it.
Yep.
But what they're going to do, so here's what I think, guys. I think what's going to happen is we're going to see people getting behind this rent and be happy scenario. And the way they're going to do it is they're going to tell the homeowners that they should be happy bringing investors in to own their home. And they can keep a part of it. So I think that what we're going to see is that people are going to get into a situation financially where they won't have a choice but to sell the only investment that a lot of Americans have, which is their home. You see, up until now, some of the only investments that I've watched people that I've sold their houses have in their entire life, because they didn't have the luxuries of hitting it rich in the stock market. They didn't have the luxuries of riding out a pension plan because they went away a generation ago, most of the time, unless you're in the government, right? Or government contractor. A lot of these pension plans, they don't exist. Before, back in the day, you hope to stay at a company for 30 years and have your Social Security, your Medicare, and your pension check, like my grandfather had, right? That was enough to live because things were affordable. Made in America. Lasted a long time. So now what we're looking at here is that people are, there's the last little bit of thing that they're holding on to called home equity. There are businesses that are popping up and propping up. There's these concepts of 15-minute cities. You see it obviously happening right before our eyes in our own community, and you don't even realize it's happening. When you look at these mixed plan unit developments that are popping up across America, the only thing that's happening in rural USA are mansions. That's where the rich live. You know, we're going to see some craziness, in my opinion, over the next couple of years.
I agree with you.
It's already started. It's already started.
Mm-hmm. Yep. I wanted to get back over onto this other screen. There was, this one. Don't be house poor because a new roof can be $20,000, new furnace or AC can be $10,000 to $15,000, but what you can afford, even if it is a 1-bedroom condo, buy what you can afford, even if it is a 1-bedroom condo. Have extra money to cover repairs, etc.
We should be building 2-bedroom houses, 3-bedroom houses.
Yeah.
We should be built. You know, more people live alone and don't have kids, right? Back in the day, there was like the average people in a home, in a household, were like 6. So that maybe consisted of, a grandparent, a mom and a dad, and a couple kids, right? Because the grandparent didn't live by themselves.
The majority of people lived simpler back then, too. I mean, they were sharing bedrooms. It wasn't like what it is right now.
And they didn't have bathrooms. They weren't en suites.
No, it was like a 1-bathroom.
1-bathroom house.
Yeah.
Grew up fine.
Grew up completely fine.
People could afford the house. You know how many people out there right now in America would love to have a 3-bedroom, 1-bath house to raise a family?
Yeah.
That they could buy. I mean, that's like...
I know.
Right? We're missing that.
We are missing
We're missing that inventory. Anyway, I don't know what's going on with my computer. I'm going to drive over it on the way home.
Having some technical
Put
issues
it underneath
today
my
with this.
tire. Go back and forth as my frustration is building with this damn thing.
It's all fine.
Have a drink of Red Bull.
We have another. While you do that, I'm going to read this super cash. I had great mentors growing up. I greatly appreciate your insight as I test my opinions against your knowledge and experience. I'm sure I speak for many when I say thank you for your time.
Thank you for your super chat. Appreciate your comment.
Yep.
It wasn't just like, oh, it's another boomer talking. And by the way, I'm a Gen X. I'm not a boomer. They make me older than I am, okay?
You just got to
May
roll
not
with
be
it
far
sometimes.
from it.
Yeah.
May not be far from it.
Todd, how do we get institutional investors to the back of the line?
You know, we talked about this, some of the things like HUD, you go to HUD Home Store, these are all of the government-owned real estate that they've taken back in foreclosures. By the way, usually when foreclosures happen, the house needs a lot of work. But they have an interesting thing. You have to wait 30 days when HUD posts a home on their HUD Home Store website. The only one that can buy it within 30 days are owner occupants, I think, or nonprofits. Then after 30 days, it's opened up to investors. So this has been, I think, talked about. One of the things that you could do is you could force a seller to not accept an offer from an investor. But here's the problem. The seller's not going to go for that. That's not going to fly. That's unconstitutional. Is it? I don't know. But here's the issue, and this is the problem, guys. When you can't afford to buy the house because you need a loan, and an investor can buy it in cash, you think the seller is going to wait or wants to wait? Do you think the seller is going to feel sorry for you as a buyer and say, oh, man, I'll sell it to you for $100,000 less than the investor will pay because I feel sorry for you and I want you to live in my house and I want your little dog to run around and have a backyard? Maybe some sellers that would matter. But I think the majority of sellers want the most amount of money that they can get for their house. And when they have an investor company that says, I will buy your house as is, I will let you live in it for as long as you need to until you find a place for free, just sign over your deed. That's happening. It's happened. It was happening a lot. We'll let you stay in your house. Just sign over your deed. Man, I don't even know whether I should go there. There is a company out there. Mm-hmm. And I know an agent that worked for them.
Okay.
You know where I'm going with this.
I have a feeling.
Basically, this company calls you up on the phone. This agent that I know said that they strategically called people on the phone that had equity in their home and that may need some money. And they said, we'll give you X amount of dollars now. It's not a loan. We're just going to pay you $1,500, $2,000. There was a formula based on what your equity was in your home. But we want you to put in your deed that when you go to sell, you have to use us at X amount of dollars. And I said to this agent, wow, man, that doesn't sound like something I would recommend. I said, did you ask your dad if he wanted to do that? And he said, no, I wouldn't let my dad do that. That's what he told me. I said, well, how many people, is it a possibility that your parents may have done that. Your mom living by themselves may have done that. And the kids didn't know about it. And then when mom passes, they list the house and go to sell the house. And then they do the title work and they're like, wait a minute, hold on a minute here. Mom took $1,500 3 years ago saying that they would list it with this particular company.
Right.
And now you owe 2 commissions. What do you think of that?
Well, I think it's unethical. That's what I think.
What do you guys think of that? All right, what else we got?
Okay. This is a recent question.
Take a couple more questions.
If you were me and had a year to make a decision, would you hold off on buying a home? Would you say yes? Would you say hold off?
You know, if I'd had a year to make a decision, I'd probably hold off.
Yeah.
Yep.
Yep.
You know, there are people out there that want to buy a house now, and you know, I say if it checks the boxes for you and you're pressed to do it, do it. But if I had the luxury and was in the financial position to wait it out, and where I didn't have to sign another lease, or lock in somewhere, or do some costly move, yeah, I'd probably wait it out. I mean, I'm a capitalist. I like opportunity. I think things are set up for opportunity. Maybe able to save 50 grand.
Yeah.
It's a lot of money. 30
It
grand.
is a lot. And
100,000, depending on what price range you're in. I mean, I don't know. I don't have a crystal ball, but I would wait.
Yeah. Talking about what the show is really about going into this with our thumbnail, talking about the price versus the interest rate. Most people are focused on the rates, which miss the point. If rates go down, you can refinance. The price you pay for a property is set. You can't renegotiate that when the market changes.
That's right. And this date the rate,
BS.
I hate that. You know I do. I cringe and we have some lenders that come in and, and they sit down and talk with us and,
everything is good until they say that.
And we're rolling right along, man. We're seeing eye to eye. And they said, look, man, it's just date the rate, marry the house, but date the rate. And I'm like, why did you have to say that?
Why?
Now get out.
It's time to go.
It's time to go. Goodbye. That drives me nuts. What that sounds like is somebody that's desperate to make a sale.
Yeah. And not like you have the best
Can
interest.
I say that? Of course I can.
Of course you can. Of course you can. Yes. All right, we're going to do this one.
And all the lenders say, unsubscribe.
I know there are lenders out there that don't believe that.
They'll call me up on my way home and be like, I can't believe you said that.
Oh, where would you guys say is the strongest organic equity region in the U.S.? The Northeast? Is there one?
I hear, and this isn't the Northeast, but I hear that Knoxville, Tennessee is poised for massive growth. University of Tennessee's there. Man, I tell you what, if you've never been to Knoxville, it's a beautiful place. I think there's a lot of opportunity there. I've heard people, say that some of the remote areas around the rural areas around Nashville. I mean, you've got so many corporations that are going to Nashville. There's so much money that's going to Nashville. Certainly Nashville's no deal. But Clarksville, maybe. There's an Army base. I know people that are looking there in that area. I think there's still a lot of affordability there. Antioch is another area that I think is close to the airport in Nashville. I hear people saying that there's a lot of value there. You know, I mean, they built the city up pretty big. I mean, there's a lot of people working there. So I think that if you could strategically look at where insurance companies are located, they don't seem to be failing. Government, you know, where there's high government jobs. I don't know that those areas are going to be, you know, as high equity as they just may be stable, more stable. I think Maryland is going to be more stable, though it did take us one of the longest in the country to come back in the '08 crisis.
Yeah.
Some people had to wait till 2022 if they bought their house in 2006.
That's correct.
In order to get out.
Yep.
That's a long time to be able to come out of it flush. But I think if you look at areas where there's high job growth that is stable, you know, maybe somewhere around these semiconductor plants that are being built, one in Texas outside of Dallas, one in Arizona. You know, if you start looking at where they're going to bring in a lot of jobs, those areas have the tendency to be the greatest areas for appreciation or stability. You know, maybe jump on some of those rural areas that are
You got a realtor right here agreeing with you. Antioch is hot. Homes are still selling. I'm a realtor in the Middle Tennessee area.
Yeah, thank you so much for the comment.
Yep.
Yeah. I mean, you know, we do keep our pulse. I mean, we talk to agents and brokers all over the country. I mean, as part of our podcast, I mean, you know, we certainly get a lot of interest, you know, and have reason to look at what's going on. I mean, I don't have a crystal ball. I just know that adding up all the economic indicators and everything that's going on, it only points in the one direction. And that's higher interest rates, lower home prices for those that want to sell, and many may not sell. And then we've got the investors that are ramping up, which is something that we really need to keep an eye on. And guys, we want to help you strategize a way to beat these investors. So I think this is going to be where we're going to be headed over the next several months to come. I want to prepare the buyers. I want to prepare you guys to be homeowners, you know, if you desire to be. And over the next, you know, 4 months, 5 months, we're going to be talking about that. We're going to first talk about what's happening. It's going to happen on Saturday. Watch our Saturday podcast. You are going to be amazed at what I'm talking about. Saturday, 10:30 Eastern time. Set your alerts. This is going to be a big unveiling of something you guys need to know about. And we are going from that point on into a series of how we will work to help our America's home buyers that have been sidelined. We are going to focus on this with our podcast on how you should be looking at the market. We're going to be following the indicators very, very closely. And because I think that all of this that we've been ramping up for since April of 2022, when we're talking about a buyer's market coming down the pike, I think we're going to get as close as we can to it. I think we're going to start to get as close as we can to it. Save your money, I'm telling you, save your cash if you want to buy a home. Get it ready. Let's get you in down payment money. We want to see you have 20% down if you can, because we want to get rid of that, you know, expensive mortgage insurance. If you don't have 20% down, start focusing on that. Share this video with people that you know that are wanting to buy a house. It's important. I mean, look, you know, I hope we're adding value to, you know, you consumers that are listening to us. You know, start saving your money. You know, get stable with your job. Do anything you can to start, you know, putting money in the bank. You know, sell things that you don't need. Get your side hustles going. I mean, let's double down on it, man, because we're going to have to combat these investors, you know, not hand-to-hand combat. I'm talking about, you know, beating them to the game on these properties. We're going to have a lot of strategies to talk about. Make sure your credit's good. Start buying down those credit cards first. Don't save money. Buy down your expensive debt. Get your credit card handled. Start saving. Stop shopping things you don't need. If you want to buy a home, you want home ownership, look, there's steps you're going to have to take, and you're going to have to be frugal. between now and then and cautious because we can't have you making mistakes. And a lot of people are like, well, I'm going to just go out and buy a car because I'm giving up on the chance of home ownership. Don't do that. If you really want to buy a home, let's get you working towards it. So anyway, one more question, we'll wrap up.
That's great.
Yep.
Okay. All right, one more
Father
question.
Todd speaking to you.
That's right, with the glasses, with the blue glasses.
I picked these blue glasses up. Somebody left them behind. It wasn't me.
There was a question here. Totally, we're just going to do it because I think it's fun. Melissa, I need help in my football league. Ravens or Steelers this weekend? I say
Please.
Ravens all the way, please. Steelers, God, no. So that's where I am.
No comment.
With that, we know how you feel, Todd. We're not going to go there. Okay, let's.
I'm sorry, man. I'm not.
No, we're not.
I sold my tickets.
Yep, that's it. That's all you need to
I
say.
had Ravens PSLs. They gone.
Yeah.
Is that a super chat? Did we talk about that?
Did we see us? Oh, right here. Oh, yeah.
All right.
Oh, come on. I'm ready for hand-to-hand combat with companies.
Oh man, you look like you are too, brother. Let me tell you something, man. You got some big arms there. I used to look like that, but I slimmed down a little bit. I wish I had arms like that.
Oh my gosh. We're going to do this for a wrap up of the evening. Do you know if tons of listings are on the secret pocket listings?
Yeah. So pocket listings technically are against the MLS regulations. You're not allowed to have pocket listings. However, the seller can elect to not have their property on the internet. I don't know why they would ever want to do that, but maybe they could be convinced to not do it. A pocket listing is where an agent is basically trying to get both sides, by double ending the deal, right? The buyer and the seller. So the strategy in that would be, to put a sign out in the yard, but don't actually put it on the MLS. You can't do that. You have to have your listing in the MLS within 24 hours of posting a sign on the property, even if it says coming soon. It needs to be in coming soon status. But a lot of times I've seen agents put homes on Zillow like it's a for sale by owner. We've caught one in that, where we're like, wait a minute. And what happened was one of our agents, they had a client that was looking on Zillow and they're like, well, why didn't you show me this one? And my agent's like, well, because it's not on the MLS. So then we challenged the agent and she's like, oh yeah, I just put it on the MLS.
Right.
Sure you did. Right. We could clearly see that it was on Zillow for 14 days or whatever. But anyway, I don't think there's as much pocket listings as there are inventory that's being held back from builders. I think the market stats are skewed, and we're going to interview. She's popular. We've got a podcast that is coming. It's like I don't like putting deposits in there, saying we have a deposit to put in the bank unless we actually put it in the bank. But anyway,
more to come.
There's more to come on that. But somebody that has proven that there are a lot of builders out there that have not listed or said how many homes they have for sale. And of course, that data would skew the numbers to where it would look like we have a lot of inventory out there, which I believe we do. So I do believe that there's what we call ghost inventory, meaning that it hasn't been listed on the MLS, but I don't think it's the right term as pocket listing, because that really refers to an agent that's holding on to a listing, not putting it out with the public to try and get both sides of the deal, or not putting it on the MLS. So anyway, guys, we love you. Thank you so much. Share this video if you would. It's the biggest sort of compliment that you can give us other than your time. We love that. That's number one. But number two would be to share us with your family and friends. Help us get those numbers up. Help us to get it out to the people that need to hear the message that is not being covered in mainstream media. Stay tuned for our Saturday podcast. It will be a treat. I promise not to disappoint. And keep those comments coming.
We're ready for Saturday. We're super excited to have that go down. But thank you all. So grateful and thankful for all of you. And it was another great evening.
All right, guys. Till next time. We'll see you soon.
See you soon.